Okay, good. Guys, thanks so much for joining me for this special update or educational webinar, really. So it's titled Trading for Beginners, when to buy and sell, where to place stop loss orders and take profit orders. So this is a beginner's webinar, and I really appreciate your time taken out from your day to spend it with me. And what I'm going to try to do in the next half hour is to try to break down and give you guys an introduction to the type of markets that are available for us, which one are good for what, which one are good for trading, which one are good for investing. I'm also going to try to explain to you why that is the case. I'm also going to explain to you a simple pattern that works across all these different markets. And that specific pattern gives us an exact idea of when to buy, where to take profits, if any, and where to take losses, if any. After that, we're going to talk a bit about money management and how much to risk per trade. Now, who am I then? My name is Alejandro Zambrano, and I'm the Global Chief Market Strategist of ATFX. And who are ATFX then? ATFX is an FCA-regulated broker. And we're based in London, of course, for now, because of the coronavirus crisis, we're all working from home. Okay, good. So let's begin then. So as I said before, what are we going to talk about? So we're going to talk about what markets are available for investing. We're not going to cover all of them, of course, because it's unrealistically to do that in half an hour, but we're going to give you guys a brief overview of the big markets that people trade. Going to try to explain a little bit about the difference between investing and trading, the pros and cons, because not trading is not for everyone, and investing is not for everyone. But there's more that really applies more to trading than investing. And then the pros and cons of the different financial markets, so you know what you're getting yourself into. And then when it's time to buy or sell, how to manage your risk, and how to manage your take profits, and how to use a specific trading platform, the MT4 trading platform. So that's what we're going to be doing. This is me, by the way. You can, of course, also, you see me here on the screen, but this is me when I visit the CMC studios. So a little bit of background then. Why should you spend the next half an hour with me? I'm the Chief Market Strategist of ATFX, and I held that position with other brokers as well before I joined ATFX. I used to be the global head of a broker called Amana Capital, which are probably the number one or number two biggest retail broker in the Middle East. But before them, I actually worked for a company called FXCM, which I worked for them from 2009 and 2016. And at the time, they were the world's biggest Forex brokers. So I've been in touch with so many different people and people that manage money professionally, retail traders like us. And I have a very good idea what works and doesn't work. But more importantly, is this little bullet that you see here in the very bottom. I've been trading the market since 2006. So I have acquired a great deal of experience, trading my own account. In 2006, when I was a student and I was about to do my second year in university, I set up a trading account with FXCM actually, and started with 2,000 euros and started to trade currencies and non-farm payrolls from my bedroom when I was a kid at my parents' house. And that's what I did in 2006. So I have quite a good amount of experience, and hopefully I can transfer some of that skills to you guys so you can pick things up faster. As well, if you do like this presentation and you want to know more about what I actually do and don't do, you can always contact me here at AlexFX via Twitter, AlexFX00. You can also reach out to me via alejandro.zambrano@atfx.com. I'm going to push all this data into the chat so you have that. So you can reach out to me if you have any questions. And here as well is the Twitter. As well, we're live on YouTube as well when we're doing this. So we do offer a premium educational course. It is free. And as long as you have an ATFX account, you get access to 4 hours of content. Effectively, you walk away with 2 different strategies and much more patterns than the one we're going to cover here today. It's all free. You can learn more about it. We'll talk about it later during the day. Now, a little intro about ATFX. So ATFX, that's their logo here on the London taxi. They're an FCA regulated broker, so you have that as security. We're London based. Now globally, we belong to a bigger family. We're about 400 worldwide. And with us, you can trade Forex, indices, stocks, and cryptos. We have the Premium Education, which I just mentioned. We have Trading Central, which is another tool that can help you with your trading. And we also offer coaching. I'm one of the coaches. We have also another team via investingcube.com. So we have, we're quite a big group. And overall, we offer good services on the MT4, good spreads, and because they are new, they're giving you all these extra bits and pieces of information to help you get going, and to help them as well to get going. All right, good. Before we start, I need to show you this. And it's really important because a lot of people, you go to Twitter and places like that and Instagram, you think it's so easy to make a lot of money, which, yeah, technically it is quite easy because you only have two options. You can either buy or you can sell. So to begin with, there's a 50-50 chance you're going to make money, but it's also a 50% chance that you lose money. So it's important that you understand risk as well. So I just need to read this out because it's one of the requirements working for an FCA regulated company. So I want to say that CFDs and Forex and spread bets are complex instruments that come with high risk of losing money rapidly due to leverage. And that 67.07% of retail investors that trade with ATFX lose money. The percentage itself is actually quite normal. In fact, it's actually lower than normal. So please bear that in mind. And as well, we're doing this with an educational purpose to support you guys in your trading. Unfortunately, just because something has worked in the past doesn't necessarily mean that it's going to continue to work forever in the future. Okay, cool. All right, let's move along here then. First things first then, which markets are available for trading? All right, here are the markets available for trading. So you have currencies, you have commodities, you have indices, cryptocurrencies, and shares. These are the main assets that people use to trade the financial markets. And currencies, you have your major and minors and exotic currencies. So the major and the most important currency pair is the euro against the dollar. That is the price of the euro, which is the currency in the Eurozone, versus the American dollar. And the reason for focusing that, because they are pretty much one of the biggest. I mean, the US is the world's biggest economy, and then you have the Eurozone, which itself is super big, but it's obviously made up by smaller countries. So that's what people tend to focus and trade on. You might say, hold on, isn't China the world's second biggest economy? Yes, it is. However, though, trading in the Chinese yuan is restricted. The Chinese government itself sets like a price of their currency, and it's allowed to trade around like that level that they set, but it's not like a freely floating currency like, for example, the euro or the British pound or the American dollar. We also have other currencies that we trade. So we trade all the majors of the euro. You have the Canadian dollar, you have the US dollar, you have the Swiss franc, you have the Japanese yen, Australian dollar, and New Zealand dollar. So those 7 different markets and currencies, those are the one people tend to trade. And then they trade combinations of these different currencies. And the benefit of currency markets in general is that you do not need to be following like hundreds of stocks. So that's one of the other assets. So if you do want to trade shares, you do need to know about what's happening within Amazon, what's happening with Apple, what's happening with Alibaba, Netflix. You need to know that a bit more. And the thing with shares as well, at least in the past, is that we have had scandals. Or for example, like Tesla, for example. So Tesla, you had the Elon Musk, for example. He said something about Tesla being about to be bought out, right? He put that on Twitter. The share of Tesla rose just because of that tweet. And, if you were trading that and you were betting on lower prices, you would have been furious, because after the fact, we find out that there was no deal. So you see, individual shares have that problem. You will have issues as well, because if President Trump sometimes wants to tweet something, you'll see the dollar move a lot. So they're not immune, but it's easier to keep track of 7 countries, to keep track of hundreds of shares. And that's one aspect of currencies trading. Then you have commodities, of course. So you have gold, right? Gold is the favorite now in times of coronavirus crisis, but even from already last year, we started to see gold prices soar. And you have crude oil prices that people love to trade as well. You might have read the news that crude oil prices went totally worthless. In fact, they went negative because nobody wanted to hold crude oil at one point in May. So crude oil and gold are two good things to focus on as well. And then we have the indices. Most people are very well familiar with indices because we have our pensions in there, and indices is overall is a good market to invest in. So you have the different indices. You got the German DAX, the 30 biggest shares in Germany. You have the FTSE 100, the 100 biggest shares in the UK, and the London Stock Exchange. You have the S&P 500, the 500 biggest shares in the US. You have NASDAQ 100, which is the 100 technology shares. And then you have many different other indices. And that's a great way of getting access to the stock markets if you don't want to get into the nitty-gritty of shares, if you don't know exactly what's going to happen with Apple, if you don't know what's going to happen with Netflix, then you can many times just choose one of the indices and you can get exposure that way. Then you have cryptocurrencies, which before, people would not put them in a list here because people thought it was silly to have them on a list and that they were just something that was going to disappear. And they have huge volatility. And if you're a trader, then that volatility is actually something you can harness. And there are certain occasions when cryptocurrencies just goes up and up and up and up, and you think, all right, it's going to stop now. No, it will continue and goes higher and higher and higher. And you still buy and you still make a bit of money. So crypto sometimes are really good, and sometimes they do the total opposite. They just plummet. So from a trading perspective, we can use them as well. And then you have shares. If you know what you're doing, if you know what the company is doing, then why not? Apple has provided great returns. If you're UK based, then you know that Ocado, for example, online supermarket has been having amazing opportunities, and the prices of that has been soaring. Another thing we cover here on Investing Cube as well, which is the website I manage, is Cineworld. Cineworld, because of the lockdown, nobody goes to the cinema anymore. I think they lost like 80% of their value. But I don't know what you think, but I think that this time next year, we'll still be going to the cinema. So it's a decline of 80-90% in Cineworld. Does that make sense? I don't think so. And other people agree with me. And we have already seen Cineworld trade higher. So there are opportunities in shares as well. There are opportunities in all these markets. Now, what should you be focusing on? It really depends on what you want to do with your time and how your appetite for risk is. So if you're a person that gets nervous really easily, and then maybe trading is not for you, maybe investing is better. And there's sometimes just no way of knowing, if you're really suited for it or not. So what a lot of people recommend is that you can have your investing account and you can still have your trading account. You just don't put in a lot of money in the trading account. You put in something that you can afford to lose, like you should do anyway with all of this. But if you lose the money, you might be upset for a bit, but then a few days later or whatever, you forgot about it. I mean, not even a day later would even be better. So it really depends. So what's the difference then? I think there are primarily two things that differentiate investing and trading. And the first thing is the composition of the returns. And that we can break down into capital appreciation or depreciation, and then interest rate, or the yield. And then you have the investment horizon. So when people trade currencies, and they are primarily trading it, and they're looking for a capital change. So they're looking for the price of something to go up, and that's how they make or go down, and that's how they make their money. It's not the interest rate component or the dividend that's going to be the driving factor. But if you invest, for example, in a share that provides dividend and has done so for many years, there's a lot of shares that gives you a few percent of dividend each year, then then you're suddenly looking to invest. For example, if you buy something a bit different, if you buy real estate, very seldom are you gonna buy a place. So say you buy a place for £200,000. You're not gonna buy a place for £200,000 and then hope to sell it maybe 2 years later for 150. No, what usually attracts people to the real estate market is that they can buy something for 200,000, and then they put a tenant into that building, and then they're gonna get, you know, a 5% return or a 10% return. So that is the yield component, and you see the difference there. You go into real estate many times because you're looking at the yields and what you can get. There's an aspect of real estate where you go in and you refurbish a house and then you sell it. Then you can almost call that the trading of the housing market. So that's also something you can do when you're flipping houses. But the normal way is that you buy a place because you want to have that rental yield income. And to get that income, because you can get interest rate returns on currencies as well, you would usually have to hold it long term. So investing in general is for people that want to hold position in the longer run. And the benefit of the longer run is that you give your investment more time to develop. Okay, you give it more time to develop, and small stuff like someone tweeting, and even something like the coronavirus crisis. I think 2-3 years from now, we're not going to be talking about the coronavirus crisis. There's going to be some other issue at that point. So all those small stuff, even the coronavirus, of course, it's not a small stuff, but smaller stuff. There's even smaller stuff, like sometimes what happens that there's tensions between US and China, or President Trump tweets or something happens like that. But then a few weeks later, people are not talking about that anymore. With investor, you look beyond that and effectively you ignore that, and you ignore the market volatility, and in the long run you get some sort of more steadier returns. What's the drawdown then with investing? Well, the drawdown with investing is that while you give your position and investments more time to develop, and they will give you some return, the return is usually going to be lower than trading. So a combination of both is usually a good idea. For example, you have a SIP, or you have an ISA where you invest in indices, and then you have a trading account where you trade, and the trading account goes faster. So, and what you will see is that with your ISA, and if you let it there for a long enough time, you'll see that it will grow. And with the trading, you'll see that sometimes it grows fast, but sometimes it declines fast as well. But in the longer run, the trading should beat the investing. So that is the difference. Usually the investment horizon. So what's long term? It really depends, but long term you're looking at weeks, months, years. Short term is usually 2, 3, 4 days. It could also be 2, 3, 4 hours. Depends on the asset. So what asset is good for what? The Forex is good for trading. Why is it like that? Because currencies will many times say they go up by 1%. The day afterwards, it can be down with 1%, or it can be down with 50%. And then on the second day, it might go up when another percent again. So it takes one step forward, say it takes 2 steps forwards, 1 step back, and then maybe 2 steps forwards, 1 step back. But that sequence does not happen very often, unfortunately. Many times it's 2 steps forwards, 2 steps back, 2 steps forwards, 2 steps back. It's a lot of that. So what people do when they trade Forex is they try to get involved. Okay, we think the market is going to go up with 2 steps. You buy, market does 2 steps, and then you close out. It's super common, very common, that you'll have your 2 steps forward and then you'll have your 1 step back. It's very common. Unfortunately, it's not so common that you can devise a complete strategy around that. So Forex is good for trading, and sometimes certain currencies, because the thing with currencies is that it only measures the relative position between one country and another country. So if both countries are growing at the same speed, their exchange rate is going to be the same. But if one country is doing much better than the other one, then the country that's doing better is going to see its currency gain faster. To give you an example, in before 2008, you had a big mining boom in the world. China was growing. China was thirsty for minerals and metals and crude oil and all of this. So over that period, the Australian dollar and the New Zealand dollar, they gained massively because they do a lot of business with China and the Far East. And you can see that the Aussie dollar was gaining a lot against everything because they were growing faster. But then eventually, that mining boom went over, and then Australia does less good and all the other countries catch up. So if you look at something like the Australian dollar versus the USD, so if you look at that, see if I can show you so if you look at that, I'm just showing you a monthly chart now. I'm just going to hide. So this is price. So this is just price data from 2002. So you can see from 2002, the Australian dollar gained by 100% against the US dollar. But since then, the price effectively gave up all of those returns. So now on the coronavirus crisis, we're pretty much back in levels from June 2002. So this is nothing you can invest in. You can invest in it sometimes like that, but most of the time you can't just buy here, hold this, and then hope that in 10 years it's gonna be in your favor, because it's something that is relatively range bound. If you look at something like the S&P 500, that one on the other hand will gain. So most of the time it will gain. In fact, let's see if I can load. Let's actually see Dow Jones. All right, this is the Dow Jones. And I'm gonna do a logarithmic chart. Look, I have data here from the last 105 years. This is from 1915. Now, from that point, the Dow was trading at 55. Now it's trading at 26,000. So you can see it's like a 50,000 return or something like that. It's something crazy. Why does this happen? Many reasons. Because the world economy, from a material point of view, is much richer than it was in 1915. And we have more advanced. The companies are making more money than before. And we also have inflation that drives this higher. So you can see for this one, if you live for 100 years, you can buy at any point really, and you goes higher. And I think that will continue because we as humans, we always want to improve. We always want to make more money. And that is driving this to the upside. It doesn't mean though that you can't have, like here from 1965 until 1982, the stock market didn't go anywhere. It doesn't mean that you can't have that, but normally it goes up. So indices are good for investing. What about oil then? And they're good for trading as well, by the way. So if you look at something like crude oil, it's also something you would not really use this one for investing for the long run. You can see here, this is data from 1983, and you can see from 1986 up until 2001, the price of crude oil was moving sideways. It was bouncing from $10 a barrel to $38 a barrel, and then it went down to 14, and then it went up to 27, and then it went down to 11, and then you had like a boom here, where it went from 11 all the way up to 149, and from there it started to go lower again. And up until recently, I mean, it went negative, so effectively it went lower than the levels we ever seen before. But you can see here as well, this is something you can trade. You can't necessarily use this to buy and hold. You can't just buy something and forget about it. The same thing here with, this is gold. Unfortunately, I don't have too much data, so it looks like it's an amazing thing. But let's see if I can actually find, I should be able to find. Let's see if we can find more data. No. All right, so right now I'm not finding what I want to find, but in the past it looked pretty much same like gold, crude oil. It trades sideways for a long period of time. It's not the best thing to just buy and hold. And here we go. Yes, we have a bit more data, but it's not enough really. If you go back, you'll see. I think in 1982 we reached levels. I mean, that it's an important high, that level 1982 or so. Overall range bound, so not the best thing. It doesn't mean that you can't trade it though. You can trade it. For example, it went from here all the way up. That's you can trade. And from here, for example, I've been bullish from about, for the last time I turned really bullish was on a break to 1300, and now we're at almost 1800. The same thing with Bitcoin. Bitcoin is something, some people would say, yeah, you can buy and hold and you can do that forever. But Bitcoin in general is unfortunately very, very volatile. So this is Bitcoin, and yeah, I don't have too much data here either. But just to give you an idea, Bitcoin reached 19,990. And from that high, it declined with 83%. Of course, if you bought it here for 280 or something like that, you would still be very well off. And maybe, 10 years from now, $9,652 per coin is nothing. But the volatility is so high that it's silly not to trade it. And it's almost a bit silly to just hold it forever to some extent, because, and for most people out there, we're not going to be buying at the very low levels. We're going to be buying at elevated levels. So for the average person, it doesn't make sense to just buy and hold these assets. So to go back to this one then, currencies are good for trading because they're overall random. I mean, range bound. Commodities are good for trading as well because they have times when they soar a lot, but in the long run, you can't be investing in this. I don't think so, at least, because they come back. They're also range bound. Indices are good for trading and investing. Cryptocurrencies are good for trading. You can, of course, also maybe say it's good for investing, but trading is what I do, and that's what I would do. And I have shares which are overall good for investing. Just don't buy the ones that are just coming down and collapsing. All right, so now you know a little bit. And another thing as well, currency trading is for someone that has time on their hand. If you have some time, you need to have at least maybe half an hour every day to check out what's happening in the currency markets. If you don't have that time, then don't do it. There are people as well that they spend the whole morning trading, so you need to have at least some time. So there's some people that try to develop strategies, so they just trade maybe in the early morning and the evening. They're different strategies. The good thing with currencies as well is that it's available and it's open when you come home after work. Actually, we're always home now, right? But you can trade it at night if you wanted to. You can also implement automatic trading strategies and things like that on it. Commodities as well. I mean, you can trade it. You need to have time, so you need to look at it throughout the day. Indices, if you're doing the investing thing, the simplest investing is just to buy the S&P 500. You buy a little bit every month. That's the simplest. If you want to trade it, of course, you need a bit of time. And this one, you definitely need time because it's so volatile. It can easily be up or down with 10%. And a flick of a switch. And then shares as well. Shares is good for long term. In fact, trading shares is difficult because shares can sometimes do nothing for 3 months. Nothing happens for 3 months. And that is obviously not the best way of using your capital because you want to keep your money working for you. Okay, so you got a little bit of an intro. And now let's talk a bit about the following. When to buy and when to sell, entry, stop loss, take profit, and money management. All right, so I'm going to show you a simple pattern because this is, as you know, it's a beginner course. By the way, you can let me know if everything is good on your end. It seems to be good on your end. but some people are saying here that they have issues. All right, so we're gonna talk about a simple and beautiful pattern that is super easy. And if you want to just trade that pattern for the rest of your lives, it is definitely possible. And you don't have to learn anything else than this pattern I'm gonna teach you now. All right, there's no other pattern you have to do. Doesn't mean that you can have hundreds of opportunities. You're gonna be busy every day. No, you won't. But you will be busy a few times per year, or maybe even a few times per month, and that will be hopefully be enough to actually generate money. Because at the end of the day, that's what we're looking to do with financial markets, right? We don't want to spend time in front of the screens just for the sake of it. It's not like a normal job really either. You need to let your money work for you and not you working for money. All right, so what am I talking about? What is this pattern then? I'm talking about the rectangle pattern. And it's super easy. It's so easy that a lot of people dismiss it. But if you can become an expert on just focusing on this pattern, you will simplify your life dramatically. So this is the Dow Jones, and you can see here's data from April, May, and then you have June. And what you see here is that the price in the Dow went down to a low here on April 21st, and then it went up to a high here on April 29th, and then eventually it tried to overtake that level, did not work out, and then it went down again. It did try to trade below it, and that did not work out. It was pushed back. So it's within that rectangle, and you have 1, 2 touch points, but you can also include this one. So there's 2, 3, 4. So you have 4 touch points to some extent. Then you have the rejection here, just 1. Rejection here, 2. You can probably count this as 3. So you have 1, 2, 3. This one is not exactly at the same level, but it's in the same proximity. So you have a nice, beautiful rectangle. And the way it works is very straightforward. When it goes above, we sell, and then when it goes below, when it goes above, we sell, and when it goes below, we sell. You can sell. If you sell, it means short selling. It means that you're trying to make money on the slide. Now, the benefit of this is that many times the difference between the low end and the upper end will give you the target. So when we finally took out this level here on May 26th, it gave us that target to go along. I bought myself in the Dow here, and then we had a target here. So this was a move of the actual move will be 7.73%. And we went all the way up to the target. Is it gonna work always? No. But the general idea is that when it works really good. So now you know a bit about the entry. And an entry is an entry, that's where you buy. So then you need to have what we call a stop loss. Now, if you follow the textbook example of a rectangle pattern, then the idea is to buy here and put your stop loss here. The problem with that is that your potential reward is going to be the same as your potential loss. And you don't want to have it like that. You want to narrow things down. So in this situation, which is quite interesting actually, is that you have a double bottom here. So on May 19th, we found a low here, and then on May 22nd, we found another low. So what we could have done here, and this is what I did, is that I actually bought here, and then I put my stop loss. So I was willing to risk 2.26% for a potential reward of 7 or almost 8%. So here you're looking at what we call the risk reward ratio. So for every unit of risk, you're looking to make almost 3 times that unit of risk. So if you risk 1% of your money, we would have made 3% here. And I have an estimation, and it's sort of 30%, I should say 40% of these are gonna work out. The rest are not gonna work out. But because you're always losing less than when you win, you still go ahead. Like in this case, it means we take 3 steps forward, and if we lose, we take 1 step back. And many times what happens is that the market goes up enough. So for example, I bought here, and then it went up, and then it went down, and then it went up. So then we could have reduced our stop loss. So it went from here to here. So you ask yourself, what's the stop loss that he keeps on talking about? So the stop loss is just the level where you want to go out in case of a loss. It's the level where you want to get out in case of a loss. And that you need to have when you invest and when you trade in particular, actually. Because what if you're wrong? That's the problem. If you're wrong, you don't want to have one bad trade ruin your account, and a lot of people do that exactly. So that's why you need to have a stop loss. So what I was saying here is that many times with this strategy, when you buy there and you put your stop loss just underneath here, what will happen is that you many times have the opportunity to reduce the risk. So maybe what you would have done ultimately is that maybe the stop loss would have been just below this low, and your actual effective loss after say 10 trades is going to be smaller than your initial stop loss. And if you can just manage that risk management good, then and you keep the profit, so you go for the big move, then you will, at least in my account, you end up profitable. So this is the rectangle. Is it always going to work out? No. So let me show you something. So there's something called the Hang Seng, which is the Hong Kong stock market. So you read the news about the whole that China imposed some new laws in Hong Kong, and people were really upset about that for a while. And they're still upset about it, by the way. And the U.S. is going to remove the special status of Hong Kong. So you had actually, this is a recent rectangle. So you had the market trading sideways like this, right? And then you had that signal to sell. So one could have sold here or here, probably here on the way up, sold here, and then on the way down. And this was something I was watching, but I didn't trade it myself. And here the idea would have been similar. So effectively sell here to target this level here. However, this did not work out, but it doesn't necessarily have to have cost you too much money, because if you sold here when we revisited the breakout point and then the mark went down, maybe you had a stop loss up here at one point, but then you would have probably reduced it. So you probably would have just lost that small amount, and of course you would have lost time, but the losses would have been smaller. What are some guidelines for this thing then? What's important to remember here? What's important to remember is that you can find this pattern in many different time frames. So this is what we call a 4-hour chart, which every block is 4 hours. Shows you the high and low, open and close price for the last 4 hours. But to keep it simple, if a pattern is at least 4 weeks and maybe even 8 weeks, that's a good pattern. It has matured enough. Most stuff that are good, you need to give it time, right? You need to have time to develop. And 4 weeks to 8 weeks is a good spot to look. 8 weeks is better than 4, of course. If the pattern is super old, like 1.5 years, it's still relevant, but it doesn't have to, but it's less good. And you can, if you want to, I mean, you can, I think even in the Dow Jones, let's see if I can pull it out here. Even in the Dow Jones, I mean, you can always go down in the 1 hour and try to 30 minutes, and you'll find something that looks like a rectangle pattern. So this is the Dow Jones. It's not optimal, but you can see here, and it did actually work out. So you have that, and you have that. So you have 1, 2, 3 touch points, and you have 1, 2 highs. Some people will call this just a normal double top, but it's definitely a range. And then you look for something like that. So you can, if you want, to go down to 30 minutes. Now this matured from June 4th up until June 5th. So that was just 24 hours. I think the reason why this specific pattern worked out is because we had the big picture pattern, the other rectangle. You still had this one, right? Remember? You had that pattern playing out. So you had the short term in combination with the big picture, and that strengthened the hand of this. Okay, do you guys have questions? Okay, So we got a question here. If you have questions, you just put them in the chat box. So how can you learn if the market is going up or down? The thing with these patterns is that you don't try to predict if the market is going to go up and down. Your job as the investor is to go, or the trader is to go through all the different markets that are available. So here, for example, I would look at, you see, I have many different different markets. So I look at so many, but I don't know exactly what's happening in euro against the Polish zloty, or the euro against the Swedish kroner. I have very little understanding of what's happening in the Netherlands stock market, or what's happening in China. I don't follow the nitty-gritty, or for example here, the South African stock market. But what I do is that I look at the 6-hour chart, and then I just look for rectangle patterns, and try to find some. And there's more than just a rectangle pattern. There's ascending, descending triangles. We have head and shoulders, bullish and bearish. And I cover all of those in that free course that I mentioned in the beginning. That's something we offer for all ATFX account holders, for free for that matter. And it's free to open up an ATFX account as well. So the idea is you identify these patterns, so you go through them, and this, you can keep it quite simple. If you're looking at the big picture, like daily chart or 4-hour chart, you would effectively go through the list maybe every second day or every third day. Sometimes when it's quiet, it will be enough to do that just once a week. So we got a question, how can we learn more about graphic analysis? So this we call technical analysis. So the technical analysis, I think the best thing if you do want to pick that up is actually to check out my educational course. I do also have a few articles. So we run a website called investingcube.com. And I have written a few introductory articles. So I have some free beginner articles here. I'll send that to you in the chat. Those are the free articles. And in the bottom here, you have this one. Here's also some more info on the trading course. So you can learn more about it. If you are interested, you can just sign up there and someone's going to give you a call and let you know more about how it works to set up an ATFX account and to get access to the course. We also offer coaching. I'll send you the link for that as well, where you get 2 hours of coaching with a real account with ATFX. All right, let's talk a bit about the MT4. All right, so the MT4 is a very popular trading strategy, and it's the one that ATFX uses. It's probably the world's most popular trading platform. So let me just load it. Just give me a second. All right, okay. Okay, so this is the ATFX trading platform, and it might look a bit scary. I don't disagree. If I was new, I would have thought the same. And it's all these flashing colors and things like that. Sorry. All right, so it's actually not complicated at all. This is the market watch section that shows you all the different products that ATFX offers. If you can't find the product you're looking for, you can right click, and then there's a button called symbols, and it will show you all the different markets that are available: currencies, gold, silver, energies, and indices. And for some reason I can't see it, but yeah, I think my account for some reason doesn't have it. But of course you have stocks, so you can trade your you know, Amazon and so on. And you can see all the different markets. You can see there's so many different markets here, and you can hide or show more, but this shows you all the different markets. And then let's make it simple. Here's the Dow Jones that we've been looking at. So if you want to look at the chart, you just drag it and drop it. Sorry about this, just give me a second, I'm just gonna cough a bit. All right, so this is the chart, right? And on the chart, it's you can manipulate. This is the 5 minute, this is the 15, 30, 4-hour daily chart. So this is what we were looking at before. So what people do is that they like to use technical analysis. They look for those patterns using these charts. And you can see here, this is what we're trading sideways, and the idea would have been to buy here and trade it to the upside. So you can have one chart, and there's, when you load it, there's usually like 4 charts, but you can delete as much as you want, or you can't add as much as you want, but you can add a significant amount of charts. And then people will do what they call technical analysis. So they will try to draw those lines. For example, that horizontal level we talked about, there you go, and then the lower part is here, and then we're going to use like a 4-hour chart, and you could see better here how this was a rectangle pattern, right? A rectangle market. You can change the colors of it. I prefer black and white, so you can see better. I don't like the grid. There we go, nice clean chart. And you can also add all these different indicators. So people talk about indicators, moving averages and things like that. You can just right click, actually you would click on insert indicator, and you have all these different indicators here. Now, for the sake of it, and I suggest you download a demo account. A demo account is this is a demo account that I use for presentation. It has fake money. So this one has fake money, $664,000. And we use it to demonstrate. So for example, I can sell. If I want to make money on the Dow Jones declining, I click on sell. And it's going to tell me, okay, you're trading the Dow Jones. Here's the volume. You can put your stop loss, you can put your take profit, and you can either sell it or you can buy it. For the sake of it, the market is going down. Let's sell a bit. The first thing you pay is the spread. That's the difference between the buy and the sell price. And that is how ATFX makes its money. So you can see on this demo account now, we're up with $160. And if I click here, close, you can see if under account history, you can see here, we made $129 on this one. Let me see here. $129 in profit for today on this demo account. So you can make money when the market goes down, and that's called short selling. And you can make money when the market goes up, and it's called going long or buying. And the difference is what we call the spread. So what is the spread? Look at it like this. If you go and buy milk, if you want to buy a pint of milk, say it costs 80 pence. You buy it at 80 pence for the supermarket, but the supermarket didn't buy it at 80 pence from the farmer. He probably paid some very low price, unfortunately, for the farmer. So maybe he paid 40 pence for that milk. The difference between the 40 and the 80, that's the spread, also called the markup. And that is how the supermarket makes the money. And it's the same thing here. So except that for a broker like ATFX, the spread is very small. The spread where they source it from is in the middle here. And we're not going to complicate it now because we can easily spend a lot of time on this. But if I click on the sell button, I make money on the selling. All right. So now I just sold, and I can go to trade, and you see I'm paying the spread. I'm down with the 32, 36. You can choose the amount. You don't have to trade big amounts. You don't have to do that at all. I put 1, but you can do whatever you want here. Like you can buy more, you can buy less. So there are different combinations that you could do here. You don't have to be like here in just a matter of seconds be down with $70 or like before what we made, about 125. And it's the same thing with currencies, but just for the sake of it, like here. So we're not trading any pattern now. I just randomly clicked on that button, okay, randomly. So this is my entry price. I can put a stop loss. So I think the market is going to go down. So the market is now at 25,970. So I can put what we call a stop loss. So I can put here, just for the sake of it, you have a high here. It is at 26, 308. So let's make it 310, okay, like that. You see, that is the red line there now. What does that red line mean? That red line is, it says SL. That means that if the market actually swings all the way back up to this level, the market will get me out. Why do I want to use a stop loss order like that? Well, because we as humans, sometimes we're not very well disciplined. So it's better to put a stop loss order before you get involved in the market, because when you have a position in, we're not disciplined as humans. And number two, we get very emotional, and people hate losing money. So what can happen here is that many times, if you don't have stop loss, it's likely that you're going to keep the position longer, open for longer, and you're going to have a worse loss than you anticipated in the beginning. Okay. You can also add another benefit of stop loss orders, that you can walk away. I can close this computer now, and on the ATFX trading platform here, the market will tell you, will get you out. So if this market swings to the upside, it will get you out there. So I can go now, like I need to pick up my son in an hour's time. I can go and pick up my son, and the computer here will make sure that it's gonna get me out. And you can close the platform. I can close this one, and when I come back, it's still gonna be there. So right now we're up with 112 or 80. Let's close this. Need to be quick. So we made on this one now, we made 47. So a total of 176 today on this demo account. So remember that. I can't take this out now and buy myself something nice. Now we showed you how to buy, so how to sell. Say now I want to buy, so I'm gonna buy. I'm probably gonna regret this, but let's buy. So I just bought now, and on this position, so I bought here, and I think it's gonna go up. So if I think it's gonna go up to, say I think it's gonna go up to, let's use the 5 minute actually. Say I think it's gonna go up to 26.18. Then I can right click here, and then I can click on modify, and I can put entry level. So I think it's gonna go up to 26,120. All right. You see, when and if it goes up to this level, sorry. Yes, it's correct. It says TP. That means take profit. If it goes up there, it will take my profit. So I can go away, pick up my son. If I had a dog, I would walk my dog or whatever it could be. I can walk away, and when it goes up, it will take me out. And then I can double click on this one again. Actually, right click and then click on one. You can also do the same thing here actually. So stop loss. You can add a stop loss, and you can put whatever you want to put. So like say I think I want to put a stop loss at 25,870. 25,807. Just put it 25,800. So if it comes down here, you see it says stop loss. If it comes down there, it's gonna get me out. And if I hover here, you can see it tells you potential profit, $1,555, or potential loss, sorry. And here it says profit, $1,676. So it will tell you from the very beginning what you will be losing or not. Then you can manipulate that. Not everybody has 50,000 to play with, so you can manipulate that. So if I go somewhere else, like let's go to the German DAX, which is really popular. So if I click here, I can double click. You can choose the volume. So when you click on one, you're buying one contract. So you're buying something worth 12,000 euros. But if you put 0.5, then you're buying for less. And you'll see here when I click on buy, actually, let's make it smaller. You see here, I bought the smallest increment. And here, my spread, the initial cost just to get going is $6. So it's not a lot. Okay, let me see here. There's a few questions here now, so I'm going to try to answer them now. So this is the MT4 trading PlayStation. PlayStation. I said PlayStation. Trading MetaTrader. Okay, so see if there's no questions here. Which time frame is best to chart for view trading indices like Bank Nifty 50 Indian indices? In general, the 6 hour, I like the 6 hour or the 4 hour or the daily, because that suits my needs. So when I'm trading, I don't trade on the very short-term charts. I have full-time jobs. I do webinars like this one. I also run a business. Plus I'm trading. So, but that's actually not the main reason. The main reason is that if you are using very small charts like 5-minute, 30-minute, it's very easy to lose money. But if you're using the 4 hour and the daily, like the moves you see there are much more powerful. So when you have a breakout out of a rectangle, then it's very likely, not very likely, I can't say that, but is higher likelihood that it's actually going to higher likelihood that it's going to be a correct trade. So now on all of these positions, we're out. When you want to close everything, just click on the button here. And, oh, wrong button actually. There we go. Close. And close. And then you can look at your account history. So we have 1, 2, 3, 4 demo trades, and we made 350 bucks today. So yeah, 4 hour is the good one. Daily is also a good one. Some people say look at the weekly, look at the monthly. Yes, it's important if you want to do analysis over that period, but very few people do that. Question, do you recommend small gains, for example, when you set a stop loss at 1% with a possible gain of 2%? I'm new and want to take it slowly. Thanks. So it's a question by Diane. I would look at trading the pattern. So as I showed you before, just look to trade the pattern. So you have the rectangle, and I would look to buy on the breakout. You put the stop loss at that level. So the basic rule is this actually. Let me see if I can show you. Just a sec. So when we trade, I said it was going to take half an hour. We spent an hour here. Let me just quickly see here if I can show you the Dow Jones again. So when the traditional rule says that you should put the stop loss on the other side of the rectangle. So you should put it here. But I disagree with that. One would be the day the market breaks out. So they broke out on the 26th. So on that day when it was moving upwards, one could have bought here by the end of the day at 25,000. And the stop loss, some people say put the stop loss just underneath the daily low. I say you can do that if you have a big candle. If not, just try to put it at a relevant place, like here. So I would have bought here, put the stop loss here, and then try to trade it to the upside, which I did actually. So instead of focusing on the percentages by themselves, focus on just trading the pattern. The pattern itself is constructed in a way that you get an average profit that is bigger than your average loss. So you see here, if we bought here and take profit was here, then you would have made 7.72%, and then you need to measure that against the risk. And if the stop loss would have gone here, you would have lost potentially 3.77. So the difference, the profit over the loss was 2 times. But that is derived from the actual pattern itself. There are other patterns that you can trade as well, as per the article I sent to you, but also per that coaching course. Okay, there's some more questions here, which I'm going to answer in a minute, but I know some of you guys are already leaving. So I want to show you just a few things before you guys leave, and then we'll continue to answer questions. See if it's the right one. There we go. So I do host videos on YouTube on the ATFX YouTube channel. So I do a big picture weekly outlook on Mondays, and then on Thursdays I do a shorter term video. Before I used to do them daily. But you can start with that. That's free. Let's see if I can send you the link for the ATFX YouTube. So that's a good way. There's a little bell button you can subscribe to me. Let's see if I can find it. Here we go. Yes, this seems to be okay. Just give me a second. So that's the link for the chat. I also mentioned my Twitter. And this is the link to my Twitter as well. If you don't want to send emails to me, you can just ping me via Twitter. On my Twitter as well, I have a WhatsApp as well, if you prefer that. So we do this, and where we look at the charts, so you get that extra help, and then we do the premium course. And here are my contact details. But let's see if you have any questions here. So Juan Carlos is asking, for Forex trade, is it better to start with 8 weeks chart to see something, chart, or see a couple of weeks when it's enough? So Forex trading, I would still look for a 4-week chart pattern. There's actually one I'm focusing on myself now. There's actually 2 of them I'm focusing on myself. Let's see if I can show it to you. With Forex trading, by the way, guys, most people trade Forex trading a bit differently than I do. But let me show you. Everything is going slow motion because we're streaming on YouTube at the same time as we're doing this. And guys, answering your questions, I know. Okay, let me check. Everything is going a bit in slow motion. I hope it's coming out okay on your end. Okay. Just give me a second here. So for example, sometimes you need to go, okay, actually, I'm going to prove it to you. In Euro USD, you had a beautiful rectangle pattern that we mentioned on the daily webinars. See here, trading sideways here, Euro USD. 1, 2, 3, 4, 5 touch points, and then you have 1, 2, 3, 4 at the same spot. And I told everybody that follows me, take this out, we can go up, and we did go all the way up. But it's not often you see something like this. But there are some stuff, and this is super exotic. I think I never traded this myself, but it's the Norwegian krona versus the African rand. You can clearly see here, you got 1, 2, 3, 4, 5 touch points. Yeah, 1, 2, 3, 4, 5, 6 around the high. In fact, we already did try to trade higher here once, but that did not work out. Sometimes that happens. And I have 2 little alarm bells, so I get a notification when this happens. And then I'll take a decision on the time. By the way, if you wonder what I'm using here, I'm using something called Trading View, and I use them for charting only. I like the charts, they're easier on the eyes, but then I trade on the actual platform. Okay, there's actually quite a lot of questions. I didn't receive them until now. Okay. Hi, Alejandro. Don't mean to sound a bit naive, but you seem to have an edge on the pattern confirmation entries by the global news. From experience, can you advise quickly byte by byte history lab needs used in the early days yourself? A question by George. Yeah, so I use something called that's okay. Yes, so I do look at the news. It's true. I look at the news and I look at correlations. So what I do every day is that I go through all the different markets, not all 120, but all the major markets. I do go through them. There's about 10 of them. And I do that because I'm trading the markets, right? If I'm investing, you don't have to do that. And what happens is that what I do is that I look, if stock markets are coming down, gold is going up, oil is coming down. If you see all these markets doing pretty much the same thing, that gives me a stronger conviction, because gold goes up in times of crisis. You also have stock markets go down, oil goes down at the same time. So when you can look at all the information and then you can also read and see what's happening, the macro news, then you can make better sense of it. And there's no specific news right now that I can tell you, like, look at this, look at that, because it's not that easy. But what I can tell you that is easier is to learn and understand the correlations. So see how gold moves, see how Bitcoin moved, see how stocks move, see how your dollar moves. When you cover 3 of these asset classes, you'll have a much better idea and you can have an indication of what's going to happen. Let me see. I think this one is another one. Yeah. So, this actually having a breakout here as we speak. This is the euro against the Canadian dollar. So we're having a breakout out of a smaller rectangle. This is the euro CAD, and this is going up now. So the question is, why is it going up? Well, probably because crude oil is tanking. Yeah, crude oil is down with 8% as we speak. Everybody's sort of in panic mode here. This is crude oil, by the way. So that confirms. Now the question is this though, is this a major high in crude oil? I don't think so, but I think if we take out 35.67, that we might go a little bit lower. I don't disagree with that. So here we can use that piece of information. And now, for example, is there any news here that is happening? I would go to something like Investing Cube and I would look here and see if there's anything here that is actually driving that decline. And if you can't find the news here, then Twitter is usually a good resource. So we got a question from Mrs. Silva. MT4 is a trading platform. It's an online trading platform, which has the advanced technical analysis and all the indicators, and people just love it. They've been using it for many years. Got a question from Nora McKay. Is it better to use up your tax-free allowance in trading ISA before trading elsewhere? Although it's disappointing you can't trade FX in ISAs. What are your thoughts on this? If you want to trade FX and so an ISA is something that gives you tax-free returns, right? Oh, if you do have returns, you don't pay taxes on that. You can open what we call a spread betting account. ATFX offers that. And spread betting accounts is something that many brokers offers, by the way. And there you don't pay tax on your profits either, as long as it's not you doing it professionally. So if you're so good that you're doing it professionally and making money out of Forex and trading in general is your primary source of income, then the taxman can come and say, look, you're a professional, so this is not spread betting. You need to pay taxes on that. So you can do that. Now, again, it really depends on what you want to do. You know, I'm going to be 100% honest. You looked at the numbers as well, and actually I've been honest the whole presentation, but you looked at the numbers. Some 67% of people do not make money. and it takes time. That's the challenge. It took me many years before I got really good at it. And the course I did is to help people so they don't have to spend all of those years. Is it gonna go quickly though? Not necessarily. And it's not for everybody, because not everybody is really good at with handling stress. So in general, one should always have different pots, right? So you have your pension pot, you have your ISA pot. Maybe you want to buy a new car, or you want to save up something. So that's why you use your ISA, right? So it depends on what you want to do and how important the money is for you. But it's good to have, the pension, you can have the ISA, and you can have the trading if you want to. I only have pension and trading. I don't do the ISA because it's almost the same. And that's what I do. So it depends, if you need the money because you want to buy a new car or a new house, so you're saving up for the deposit or so, then you don't trade with all that money. It wouldn't make sense. And are you gonna make it? Unfortunately, I think the best way is actually just to give it a try. You put whatever you want to put in, and then you take it from there. How can you access MT4? Yeah, so to access the MT4, just go to ATFX. Actually, let's do like this. Go on I'll send you the link. And then what you do is that actually you ignore that link. Actually, if you want a demo, click here. Actually, click here. Yeah, I will send you a new link. Otherwise, you can just go to atfx.com. Yeah, this one is good actually. Actually, I'll take that back. It's not a good one either. Here we go. I think it's this one. Look now, just do like this, atfx.com. And in the top here, you click on create demo account. So in terms of leverage, currencies you can use up to 30 times that you have on your account. I think indices is 20 times, and shares is 5 times. And then there are some markets that are in there in between. Some of them are 10. Randy Smith says, can I just decide, for example, to take 30% off the table and let the rest of the position ride? Yes, you can definitely do that, and that's something actually that I do quite often, and it's quite straightforward. Unless you buy the minimum. If you bought the minimum, then of course you can't get rid of the minimum. But if you bought multiples of the minimum, then you can close that on the MT4. And when you have a breakout of a rectangle pattern, when you have a little bit of profit, like a chunky, not a chunky, but a decent little piece of that, is good to book 50%. So if it does swing back, you're going to be sheltered from any shock, because the problem with the pattern is that sometimes, or quite often, you have false moves. There are certain years where breakout from these patterns works terrifically good. You're minting money. And then there's other years where you barely make almost no money on trading patterns and breakouts. So what people try to do, like people like myself, is that you try to have a strategy for the normal strategy, and then you use some other strategy that you trade alongside. So you have two strategies, and then the purpose of that would be to mellow out the returns, so you don't have like super strong returns, and you don't have extremely low drawdowns. And that's what a lot of people do. And if you don't want to do that, because developing systems, it takes time, then you can just trade that pattern and maybe add a few more patterns, and then you just do that and just say to yourself, look, I have my normal savings, and then I have my other stuff. And sometimes we have terrific years. I had triple digit returns, so more than 100% one some years, and some years I'm down with 25, sometimes down with 30, but that's my trading capital. and then you have all the other bits and pieces as well. Okay, so right. Yes, you can spread bet on US shares. So spread betting is available if you're based in the UK or you're based in Ireland. Then that's how you can do a spread betting account. And that's it. I think we reached the very end of the questions. Let me just go to YouTube actually and see if there's anything in there. But otherwise, I think we're gonna wrap things up. I hope you enjoyed it. So the presentation is available on YouTube. I don't know what the quality is. It's always a bit tricky when you stream. Because I was streaming on YouTube and at the same time doing this with you guys. But it's available on YouTube there. I'm gonna see if I can send you an email as well after this with all these different links. And you can always reach out to me. It's, as you can see there, it's my first name dot last name at atfx.com. Mauricio says good afternoon. All right, so we don't have any questions on YouTube, which is all good. Okay, guys, I want to thank you so much for joining me, and I hope to see you guys for another webinar. I think we have a webinar on the 24th, and yeah, just follow me on Twitter and follow us on the YouTube channel, and I'll send you some more info about the next webinar we're coming up. Have a great day, guys. Thank you so much, everybody here, and you asked some really good questions today, and I like that. Thank you so much. And I'll see you guys soon, hopefully. Thank you, and bye-bye.